Hi there, my wonderful Midas letter subscribers. Guess who's back? It's Charles Taerk from Faircourt Asset Management, Ninepoint Alternative Health Fund. Charles, it's been a long time since we've chatted, and obviously you have not slowed down in any way, shape, or form from investing activity in the cannabis sector. Your top 10 holdings currently: Cresco Labs, Curaleaf, Green Thumb Industries, GW Pharma, Jameson Wellness, Johnson & Johnson, Terra Ascend, Trulieve, United Health, and Village Farms International. Almost uniformly US MSO oriented. Why is that?
Oh, well, we need a day and a half. But let me give you a few reasons. Last year, it's funny that we're on in March, because if we go back to March 20 versus 21, this was the worst, the very beginning of the lockdown. And in the beginning, the first thing that happened was US cannabis became an essential service in 29 states. That was huge, because what it did was it reinvigorated the cannabis industry and it awakened people to the demand. And what we've really seen is inelastic demand, very similar to alcohol and tobacco. Then you got the first stimulus checks in April. And on April 15th last year, the largest single day of sales across the US in cannabis sales. As the lockdown ended in June, you then started to see this demand month over month just continue to grow. We took that early opportunity as the lockdowns ended in beginning of June in the US, and we reallocated our portfolio. We were being very defensive, alternating into our healthcare side during the pandemic. We started moving into the US names in a bigger way. We always liked the US names, but their valuations were screaming buys. And so you see inelastic demand, month over month growth, and the state by state growth that we started to see on the horizon finally came to fruition. You had November, the ballot initiatives, where we had 5 states that legalized. Some of them were even Republican, traditionally red states. That was huge. I mean, the biggest one is obviously New Jersey, because what we see going forward, and the reason we're still overweight US, is with New Jersey is the domino effect. All the neighboring states around New Jersey are going to be forced to go adult use recreational. And already we're seeing that. Maryland, New York is on the verge, and you're going to see Pennsylvania and Ohio and Connecticut, Rhode Island, everything around the Northeast. And so this is going to be a significant flip over the next 12 to 24 months with a significant amount of the US population. So after 2020, when you had significant growth, you had significant growth in other growth areas too. And it's very interesting, because I compare US cannabis to other growth sectors like tech, the work from home stocks. I like how you asked me one question and I'm talking forever, but the work from home stocks did phenomenally well last year. But in 2021, the economy is reopening. We're not staying at home as much. We're not going to be tethered to our desks at home. So we see growth in the work from home and tech stock kind of leveling off. But the total addressable market in the United States continues to grow. And so that's why we are continuing to be overweight US cannabis. Plus, the valuations are screaming relative to other growth areas like tech. They're trading at a fraction of the valuation. Long-winded, but that's my thesis.
Yeah, no, that's rather consistent with my observations, and in fact, it's heartwarming to see that somebody else is following the metrics that matter. In your opinion, is it very severely detrimental to the future of cannabis profitability among US MSOs that the Biden administration has kind of exhibited a somewhat hypocritical approach to cannabis legislation, in that the campaign was very clear about its support of decriminalization, if not national regulation of cannabis. But then now Biden has just fired 5 White House staffers for past cannabis use, demonstrating a real conflict of position there. And in my observation, the US MSOs sold off alongside that. Mind you, it was coincident with a broader market sell-off in the last couple of weeks anyway, so really hard to discern there. To what extent do you think that is going to put a pause on the growth in the appeal of valuations of US MSOs going forward?
Yeah, it might have some effect because it's, grabbing headlines. But for us, since last June, and this continues, the thesis is that at the state level, the state-by-state growth is more meaningful than what's going to happen at the federal level. We don't know when Washington is going to make a decision one way or the other, whether it's the SAFE Act, which is just banking, or whether it's the States Act or the MORE Act or whatever. But what we do know is the demand at the state level continues to grow. And what I mean by the demand is that governors are looking at neighboring states, and the governors that are digging themselves out of a negative economic hole from lockdowns are asking, what's the fastest way that we can recoup tax revenues and jobs? And so regardless of what happens at the federal level, this is going to continue. And so fundamentally, these companies are strong. I think if anything, Biden's administration was never openly supportive of cannabis. The Democrats generally have been supportive, but he's been very vague, wishy-washy, if you will, on how he's going to support it. Kamala Harris, different story. She was the sponsor of the MORE Act in the Senate. But Biden may have a different view, and that may moderate over time. But I think the big issue is state-by-state growth. And if anything, rather than suggesting that it's detrimental, I think that it's actually supportive for the MSOs, because the longer the federal government in the US does nothing, the incumbent players continue to build a moat around their business. So Canadians will not get into the US market. Other countries' cannabis companies don't get into the US market. The traditional alcohol, tobacco, pharmaceutical companies stay away. So it will allow the incumbents to continue to grow. And again, it's why we stay firmly invested.
That's well said. Well stated. Well said. So okay, in that context, then, among your top 10 holdings, which company do you view as being the best positioned to benefit from a lack of federal regulation amidst growing state demand?
Well, there's a lot of issues, but I will give you a name that sticks out more than ever. I'll give you a few. Well, number one, we think Green Thumb Industries, phenomenal execution, continue to grow their state-by-state footprint, both on the wholesale as well as retail side. Then you've got Trulieve in Florida that has just mastered and continued to grow out of Florida, and they're now in Pennsylvania and Connecticut, as well as some other states that they're getting into. So they're going to continue to grow. They've got terrific gross margin and EBITDA margins. But I think this year, kind of a sleeper name, and it's not really a sleeper, but Columbia Care is executing at a phenomenal level. And the reason I say they're a bit of a sleeper is that they're trading at a discount to many of the other multi-state operators. Columbia Care is in 18 states. They've got the second largest national footprint in the US, only behind Curaleaf. And they've made 3 major acquisitions in the latter half of last year that have really positioned them for solid growth. They bought the Green Solutions, which was Colorado-based. Then they bought Project Cannabis in California, the largest cannabis market in the world. And then they bought Greenleaf Medical. And Greenleaf Medical is in the Mid-Atlantic and Northeast. And so when you talk about leverage of these new states that are coming online, they operate in several medical-only states that could be flipping over the next 12 to 24 months. So you've got New York, Pennsylvania, Virginia, Ohio, Maryland, and then looking 2 years down, Florida. So we see great leverage to what's going on in the state-by-state trajectory. And we think Curaleaf also, they hit it out of the park in Q4. They just came out, did revenue of $81 million, 51% growth quarter over quarter with commensurate EBITDA strength. So, one of the big differences that we see between the Canadians and the Americans, why we don't support the Canadians as much, is the Canadians aren't generating any free cash flow. And when you compare the top 5 Canadian cannabis companies and the top 5 US cannabis companies, you have a dramatic difference in the profitability. Zero cash flow being generated from the top 5 Canadians in calendar 21, whereas there's close to 1.4, 1.5 billion forecast for the top 5 US companies. So again, fundamentally, we think people are missing the boat here, continuing to focus on the Canadians and not looking at the Americans.
Mm-hmm. Very interesting, Charles. Okay, we're sort of running out of time here, unfortunately, today, but tell me a bit about the performance of your fund in the last year, since you guys seem to be having your thumb right on the pulse of the US MSO scene. How has that benefited your unit holders?
Well, I use the Wayne Gretzky analogy a lot. Doug Watterson and I that co-manage the fund, we try to skate to where the puck is going. And that's really what we've done in continuing to position the fund a little bit differently. So last year, depending on whether you had the A class or the F class, we did somewhere between 37 and 40% total return for the year. And so we're very, very pleased that we were able to maintain the NAV during the weak period in the first 3-4 months of the year, and then really accelerate it out through the balance of the year.
Mm-hmm. Fantastic. Finally, Charles, tell me about the effect of the Canadian, why Canada continues to suffer such a challenging environment in making money. Where I've moved to for the duration of the pandemic is a little corner of rural southern Ontario where there are so many greenhouses that are just tiny startup licensed producers nonetheless, but they're massive in footprint. They're churning out so much cannabis. And I'm watching retail outlets go broke at a fast clip in the general Southern Ontario region. And so, couple that with the headline item I saw that there was 1 billion grams left unsold on the shelves of retailers in Canada as a result of what is obviously an excessive supply relative to demand. Is there some shortfall in the legislative framework in Canada that is preventing Canadian companies from being profitable relative to U.S. ones?
Well, I think there's blame to go around. Look, the federal government legalized cannabis. I think when investors and when founders of these companies went to get licenses, there was no gatekeeping in terms of how many licenses are we going to issue relative to our population. We've got 37 million people, and there's over 300 licensees across the country. Then you had the largest companies really spend too much money. Hundreds of millions of dollars were spent building massive greenhouses, and yet the distribution wasn't able to take that supply. So you've got a supply glut with very expensive greenhouses, which are now being shut down or reduced in cultivation capacity. Over the last year, Canopy reduced over 60% of its cultivation footprint. Aurora closed its Aurora Sun project in Medicine Hat. That's 1.7 million square feet. Just shut it down. It's now for sale. And then Aurora Sky in Edmonton is operating at 25%. So we've got a glut of supply, which has also gone into the distillate market, the oil market, to make edibles. So what you've seen is price compression and commoditization. They will get through it, but it's going to take time. And really, I think the final problem in Canada is the lack of marketing that's allowed. the legislation, this is another key area, and I think this is being discussed with regulators, both at Health Canada and within the government, is by eliminating the ability to market products. The only time you can get information is if you go into a store. Otherwise, this industry, you're relying on word of mouth, which can be suspect, but people need to be educated. It's the naive user that's going to grow this market, and it's not all the illicit market. And you want to compete with the illicit market, except they do a pretty good job of avoiding the rules. And you've got a bunch of legal companies that are confined by the rules. And so I think if we take a look at some of the initial legislation that was designed to protect the people, I think we've got to adjust our focus, and that way some of the kinks in the armor get ironed out.
Charles, as usual, a very thoughtful and thought-provoking contribution. Thank you for your time today. We'll come back to you soon.
Thanks very much. Great seeing you. Be well.